In less than a decade, several crypto millionaires made fortune investing in digital assets, which is the case of Eric Finman, who began investing at age 12 in 2011 to become the world's youngest Bitcoin millionaire at age 18.
Are you trying to trash talk me?
However, before knowing how to make the right moves in the crypto game, it is crucial to know how to avoid the bad moves when you buy Bitcoin and cryptocurrencies in general. In this video, we're going to count down the 5 worst cryptocurrency investing mistakes you should definitely avoid. Let's dive into it. Number 5. Putting all your eggs in one basket. Risking it all for one venture. That's one of the biggest mistakes most new investors make. If you want to play with crypto coins, it's wise to consider spreading investments across multiple diversification strategies. Investing big on one coin could ruin your wealth and future investing plans. This basically means that you've put all your eggs in one basket, and you're betting that that's going to work. And most of the time, you're never going to be 100% right. So you need to diversify and assume that you're going to be wrong and have some sort of hedge. Portfolio diversification is widely seen as a strategy to reduce the risk of major loss. So let me explain what I mean by that. There are a few different ways you can do this. Number 1 is within your cryptocurrency investment portfolio itself. Basically, instead of just buying one cryptocurrency and being 100% sure that you're right, you might want to buy a few different ones. This way lowers the risk because you never know. Your third or fourth option might outperform your top pick. The second way of eliminating risk could be this way. You are very confident in one cryptocurrency. Let's say you have a strong conviction in Ethereum, for example. So let's say like 75% of your portfolio is in ETH. Then you break up the rest of it by investing 20% in Bitcoin and the other 5% in some altcoins that you think are going to perform well. This way, you are spreading your risk. Even outside of crypto, you want to diversify because there's no guarantee that cryptocurrency prices are going to always go up. Something bad could happen. The market could totally go the opposite direction. The recent dip in the market is a perfect example. So it's really risky to put all your available funds into cryptocurrency. There are many people who do it, and some of them get incredibly rich. But that's not the case for everyone. Number 4, buying crypto because it's cheap. The second common mistake that beginners make is buying a cryptocurrency because it is cheap. Alright, the logic usually goes something like this. Hey, I'm going to buy Litecoin, for example, because it's way cheaper than Bitcoin, right? And if it ever goes up to Bitcoin's price, then I'm just going to be a billionaire. Well, not really. Well, there's an enormous problem with that. You're looking at the unit price of the cryptocurrency and not thinking about the market cap. Let's say the value of Litecoin is $50 compared to Bitcoin being $20,000. Well, the real problem with that is you cannot factor in how many coins there actually are in the supply. The reason that you know Litecoin is cheaper than Bitcoin is that there are more coins in existence when you're looking at the unit price. You also have to look at the market cap, which is basically the price of each coin times the supply. Compare cryptocurrency that way, because that'll help you determine whether it's even plausible that a coin like Litecoin would surpass Bitcoin in value. That's an important step to factor in, because in order for that price to go from, let's say, just $50 up to like $20,000, then the market cap would have to go up about 400 times, so the entire market cap would be worth trillions of dollars, which is an incredibly unlikely scenario. So we have to think about other factors besides just the unit price and avoid buying a cryptocurrency just because it's cheap. Number 3, buying more than you can afford to lose. I can almost guarantee you that if you're a beginner, you're probably going to lose money in cryptocurrency. Maybe not over the long term, but you'll probably lose money at some point. The problem is that many people buy more than they can afford to lose. So when they actually lose money, whether it's just paper losses or actual losses, this does affect adversely. An example with this would be like if you have enormous outstanding debts. You have enormous purchases that need to happen, or other just big investment goals, and you take that money and you invest in cryptocurrency. Let's say you lose that money, because it is a gamble at the end of the day. That being said, it's not always the end of the world if you lose that money, especially if you have the means to make more money. But many people make the mistake of betting large amounts of money. So you have to be really careful when you're thinking about what amounts to invest. Another thing is that it's hard to make a life-changing amount of money with cryptocurrency without putting in a significant amount of money. And that could make you sick to your stomach when you watch the prices go up and down. It is important that you find a fine line of investing money that makes you feel you've really put in something, but also not so much that if you lose it, it would be a wreck. Number 2, buying on speculation. Buying on speculation is the worst mistake many beginners make, and this could often lead investors to buy high and sell low. Many newcomers just want to ride the rally and make profits without thinking about the future prospects of that coin or what factors are actually driving the coin's price higher. Early this year, speculation about the massive level of crypto adoption, as well as broader crypto market rally, have pushed both retail and institutional investors to buy various coins at a higher price. Crypto markets are volatile, and it's quite difficult to predict the future price movements. Investors who had bought digital coins on the recent surge lost money this week following a surprise collapse in crypto markets, which is blamed mostly on a ban on Bitcoin from Tesla. Increasing Chinese regulations and uncertainty contributed to the sell-off. Number 1, buy high, sell low. The first mistake that beginners often make is buying high and selling low, which is really the exact opposite of what you should do. But you need to buy low and sell high. Don't feel bad. People have lost a lot of money investing in cryptocurrency this way. I want to show you the most common way that people do this so that you can avoid it. It's really common for people to look at a chart and watch the price of cryptocurrency go up like crazy and think, oh, now's the time to buy. People jump on this opportunity, thinking, I need to catch this train before it leaves the station, right? It's really common for beginners to watch these big pullbacks in crypto, then get scared and sell it, and then they lose the money. But the next day, the price recovers, and then that same cycle continues. So this is probably the most common way people buy high and sell low, but it's the exact opposite of what you should do. Basically, train yourself to think the opposite. So whenever you see a big run-up like this, typically, that's not the time to buy. Usually, you want to wait for things to cool off before you jump in. There's a saying, be greedy when others are fearful, and fearful when others are greedy. And there's a lot of truth to that. You can't systematically do that because, of course, you would buy every single cryptocurrency that ever went to zero. But there is a way that basically helps limit your risk to where you don't have to try to call tops and bottoms. So that just means buying a little of a cryptocurrency over time and then averaging your buy-in price. Basically, let's say you want to invest $1,000 in cryptocurrency. Then, a dead simple way to do this would be to divide it by 4 and then buy into the market 4 different times. So you basically take $250 and you buy the same cryptocurrency at 4 different points in time. Maybe it's once every day, once every week, or once every month, etc. This helps reduce your risk in these incredibly volatile markets. You simply buy cryptocurrency at 4 different prices at its trials. Then you sum it all up, divide by 4, and get an average buy-in price. Now that you have seen some of the most common cryptocurrency investing mistakes to avoid, be sure to use them to your advantage. Build a strategy, do the research, find knowledgeable people that you can go to for direction on which crypto you should be investing in and why. This video was not meant to give any financial advice, but purely created for educational purposes. We hope you enjoyed it and learned something. Don't forget to leave a comment down below and be sure to subscribe to our channel for more, as well as many other topics that you will enjoy learning about. Until next time, thanks for watching.